Welcome to Quantcar's latest podcast. My name is George, and I'll be your host today. With someone like me who plans to retire in the next 5 to 10 years, it's becoming clear how complicated retirement planning is and how human emotions can prevent good outcomes. We naturally want to see our money grow, but also we want sustainable income. To me, the decision often feels binary. You can have growth, but not income, and vice versa. But what happens if you want both? Is that possible? And what do I give up to achieve this? Today, I'm delighted to be joined by David Jane of Premier Miton, an experienced fund manager with several decades behind him. He currently runs 4 funds, including income strategies. And we're going to dive into income investing and its crucial role in retirement planning. How can this strategy help us when we take an income in retirement? So, David, welcome and thank you for joining us. Can you provide a potted history of your career to date?
Yeah, well, I started in the industry in the late 80s as an analyst at various life companies and Newton along the way. But ultimately, I started running mixed asset funds around the year 2000 when I joined M&G, which at that time was a sort of very famous income house, perhaps had been sort of pathfinding income as a strategy back then. And as part of my role as head of investments, I took on the mixed asset funds at that business, which sort of seemed to fit well with my previous experience. I've been a financials analyst, and financials and sort of macro really go hand in hand. So I ran mixed asset funds for, I suppose, over a decade and launched a number of new mixed asset funds to take advantage of various regulatory changes that occurred during that period. And obviously during that period, M&G itself had a tremendously good run of outstanding performance. The interesting takeaway really then, which I've sort of gone on to disprove, was that I came to the view at that time income wasn't a very good strategy, that we were running a lot of income funds around at M&G at that time, and they were underperforming and they weren't doing well. And largely because these were very dogmatic income strategies. They, we'll only buy it if it's got a yield over this, and the fund must have a target yield ratio and this, that, and the other. And, looking back on my time at Newton, we ran income strategies to grow the income over time. And I thought that was a much more worthwhile strategy for clients. And ultimately left M&G in 2010 and set up my own business, Darwin, which has subsequently bought by Miton, which is subsequently bought by Premier. But at that time, I launched what's now known as the Premier Miton Cautious Monthly Income Fund, really to target the post-retirement market. I had the view that people needed low risk, low volatility mixed asset strategies, and they needed them in a form of an income post-retirement. It's only really coming into its own now, but now it's 13 years on that track record, and I think it's the results speak for themselves.
Can I just, for somebody listening to this and possibly they've never come across the term mixed asset before, can you just give a very kind of brief outline as to what that means?
I can give you another bit of history, actually, and
Yeah.
it'll go to a lot of the points that we're going to talk about later, actually, which is, mixed asset strategies really came out of a number of regulatory changes back in the early 80s when bonds started to be allowed in unit trusts. So a long time, the unit trusts had to only invest in equities, and bonds were not an investable asset because they trade over OTC, and after a bit of lobbying, bonds sort of came to be allowed. And so you got this sector called equity and bond income. And that ultimately merged in with what was then known as the cautious sector, now the 2060 sector, and gathered a lot of assets. And these managers, because it's actually only, again, in the early 80s that you could invest in overseas equities. So a lot of managers basically ran UK equity, UK bond strategies. And that was the sort of beginning of the mixed asset sector. And then really as the industry broadened out, you started to get desire for defensive strategies and growth strategies within a mixed asset context. But ultimately, mixed asset funds now, as they're currently formed, can invest, yes, in UK equities, but also international equities, yes, in UK corporate bonds, but also in gilts, international bonds, emerging market bonds. And with the regulatory changes that occurred in 2010, I think it may be 2009, you could now invest also in commodities and various other sort of specialist assets. People call them alternatives, but I typically call them funny money. But now the mixed asset sectors can pretty much invest in anything they so choose. My view is, with all the changes that occurred, the purpose of these funds is essentially to meet particular client needs. And I see it as outcome-driven investing. You're not really trying to say, there's no client ever walks into an advisor says, oh, I need 60% exposure to equities and 40% to bonds. Nobody says that. They say, oh, I've got this risk tolerance, and I've got this long-term income need or this long-term capital growth need. We should be delivering outcome-driven strategies in our mixed asset sectors. And advisors are much less concerned what goes into it as what comes out of it.
So that leads us quite nicely onto what comes out of it. And also kind of my point in the introduction is that we have been in an environment of low interest rates and inflation following the financial crisis. And I know for some, that's all they've ever known. So it does appear that income investing as a style seems to have lost its way. And I think the point that I was making at the start was that for somebody who's coming up to retirement and you have this kind of human emotion where, how do I invest? Income investing lost its way. Growth is where you make your money. And so on the basis that there is a feeling that it seems to have lost its way, why do you think that is? Or do you think that thinking is perhaps wrong?
The fact that it lost its way is absolutely true. And the reason that occurred is that the period, really, you could roll it back really from when the tech bubble burst, actually. But we went through a very long period of ultra low interest rates, ultra low inflation, and it really became extreme post the GFC. Essentially, that period where interest rates are very low, growth is low, inflation is very low, fundamentally favors growth as an investment style, such that you've got much lower discount rates, those long duration growthy assets, the tech stocks and so on and so forth, basically fundamentally outperform in that environment. I would argue that environment was broadly abnormal, because you've got a number of other characteristics with that environment. You've got the fact that bonds and equities became negatively correlated because of the low interest rates, so on and so forth. And because every time there was a problem in the economy, it wasn't inflation, it was growth and it was leverage. And so I would argue that was an environment that very much favored growth as a style. Income is a subset of value, arguably. And so income as a style fell broadly out of favor. And as a consequence, actually, a lot of income managers became quasi-growth managers, actually, that they wanted to be more growthy. They wanted to find ways around generating income that wasn't sort of natural, sort of finding companies with good dividend yields that are growing, because all the action was in the big growth stocks. Now, that has ended if you buy the hypothesis now that interest rates will be structurally higher over this decade, by which I mean structurally normal, because the period from 2008 onwards was very, very abnormal from an inflation and interest rate point of view. That period of QE, so on and so forth. The inflation's now back, whether you think it's going to go, back to 2 or something in the near term. Very few people think that inflation is going to average 2% over the coming decade. And if that's the case, you'll get a more normal investing environment where, obviously the best of the growth stocks will be the best stocks, but income won't be out of favor as a style. It will be neutral. And actually, if you look at periods where inflation has been relatively high, say through the late 60s into the early 80s, income as a style fundamentally outperformed, which is why it became so popular in the UK for a long period of time. It fundamentally outperformed for a very long period of time because you were in a period of relatively high inflation, relatively high interest rates.
So kind of just touching on that a little bit, and you're talking about this more normal environment and kind of the lost way. I guess one of the things is that is I just kind of pushing on that point is that often when we look at income, perhaps we look at it and say, a company is paying. So if we take Shell as an example, Shell is paying a dividend of, say, 4% a year. And then when they remove that dividend, we then feel that income isn't working. What I guess you're saying is that it's understanding whether that income is sustainable and whether it's growing. And that's what true income investing is about. Is that kind of the right way of looking at it or the wrong way of looking at it?
I think it's important. There are 2 points I'm making, actually, and I think they're both very, very relevant. One is when we're thinking about the funds I run, income is the output, not the input. I need to run income as not necessarily an investment style, because we had to run this as a fund during a period where growth was hugely in favour, and we ran it successfully with a decent yield and grew that distribution each year. That's what we're expected to do with these funds. People really shouldn't be so worried. But at the same time, income must be an important input into the fund. And so we have to identify companies with decent yields and so on and so forth to blend with growing companies, and the same in the bond market and so on and so forth. We need to find attractive income generating bonds that are appropriate to our overall investment strategy. But it doesn't preclude us buying things with no income. We can buy commodities, we'll buy gold, we'll buy pure growth stock with no income whatsoever. As long as the output of the fund is that growing distribution over time. But the point about identifying, companies with decent distribution prospects, I would broaden out to the whole portfolio. You cannot run a successful income fund with a growing distribution over time without putting capital growth into the portfolio. You've got to have both. Chasing yield, maximizing the distribution in the current year, come what may, is a strategy that's doomed to fail, because ultimately you'll end up pushing the income too hard. You'll buy the worst stocks with high yields, who cut their dividends and so on and so forth. You've got to look after total return to run a successful income strategy, which means being rational and sensible about how much you distribute. And then, you can grow that income over time, because that's what people want. They don't want to maximize the income this year and then, have a problem from a capital return point of view. They're going to be retired for 30 odd years. That money must grow over time.
So, because I think that's really interesting, and it kind of comes on to this kind of the next phase of this, is that we've seen quite significant changes in pension planning, and I came across, I think it was 2015, was we had these changes which meant that people could access their as much as they wanted from their pension. And I know at the time there was all these headlines about people taking out all their money and buying cars and so forth. And just looking at recent FCA retirement income data, and I'm sure there's a reason for this, but in 2015, 90% of pots were moved to annuities. Annuities, for anyone listening, are where you effectively use your pension fund to buy a guaranteed income. And then this has kind of dropped to about 10%. So the FCA have now done this thematic review, which has concerns about how advice is provided in the retirement market. So my question to you is kind of, it's interlinked, I guess, with what we've been talking about with the income side. But why do you think retirement planning has come to the forefront of the FCA's mind recently?
Well, there's a number of related aspects to this, aren't there? But the one point I would make about, the clients, it didn't turn out anyone actually did in the end, but the people who supposedly might or could have taken their whole pot out and blown it on a fast car, it's their business. It's their money. fine. If that's how they want to spend their retirement, leave the rest of it in poverty. That is fine by me. I don't think, and this is where perhaps I clash perhaps with the FCA from time to time. I think people are grown-ups and they should be allowed to make their own mistakes. But clearly it's a political issue. Having a lot of people in this country have, accessed their pots, and they've made pension transfers, and they've gone from a world where they were going to have a sort of guaranteed company provided income stream in retirement to one where they're now reliant, hopefully with advice, on their own decisions, so on and so forth, creates, a risk politically if a lot of people got into bad issues. And then, of course, so there is a huge block of assets in this position now. They're in late working life, early retirement, and I think the FCA has realised that actually this business is a lot more complicated than pre-retirement, whilst at the same time it's also a lot more politically sensitive. These are pensioners, and so that's also become the case. So they're absolutely right to have a deep dive look at it. I don't deny it, and at the same time, I think around the last couple of years, you had a number of people who moved into retirement during periods of market volatility, and that brought the whole issue of what a safe withdrawal rate is, what is sequencing risk, so on and so forth, to the front of people's minds. So I think, reading that review, a couple of things really jumped out at me. One is they clearly get, and I fully agree with this, that immediately pre and post retirement and into retirement is a much more complex advisory job than accumulation. And accumulation is complex on its own, but post and retirement is really complex and difficult and is a big issue. And there are a number of things that come in there, where should you just be relying on risk profiling post-retirement, or should you be thinking about other aspects, longevity, so on and so forth? The real, huge risk that comes with sequencing post-retirement, where, potentially if there's a major drawdown, you really do shorten the life of your assets materially, and then later life, and the risk of these very vulnerable clients whose pots are shrinking quite rapidly in later life. Again, that's a very complex and challenging advice. And I think the FCA were right to draw people's attention to it. Absolutely. And I think a lot of firms now are having a really good hard think about how they address post-retirement in a different way to the pre-retirement. It's easy to be flippant about it, but pre-retirement is about risk profiling and how much can you afford to save. Yeah. Post-retirement is it's hugely more complex than that.
Your thoughts behind that, it leads really nicely onto this other question, which kind of also flows into the kind of argument between growth and income. And, I see this quite a lot, and possibly things are changing. And it's this kind of school of thought regarding producing income in retirement. And there's one that says, I've got an investment fund and I need an income of X. And the way that I'm going to achieve that is by selling down the units of that investment. And again, it comes back to my point at the start, is that I want to see growth. So if my fund grows and I've got it in an adventurous portfolio, let's say, that's a great strategy in my head because I get the growth and I get that. The second one is one of natural income, which you've talked about, and this idea of looking at the outcome, and effectively by taking natural income, you keep your units, and you're just pulling out what is naturally produced. My feeling is that you're more in favor of a natural income, and because I see so many different arguments or and against, why do you favor that as a route?
And do you know what? I get both. I mean, again, a bit of history, for a long time, the platforms wouldn't allow natural income. They wouldn't enable income. They'd only put your ACT shares on the platform. They wouldn't even put the Inc shares on for a long time. And of course, we've talked about why income as a style was out of favor. We can all sit down and do a huge spreadsheet and say that drawing the income or drawing the same amount as capital is an equivalent strategy. That's a truism, isn't it? It's just a mathematical truism. And therefore, what's the big fuss? Why the excitement? Why do people like ourselves think that natural income is the obvious way ahead? Well, the big challenge in retirement is sequencing risk. How much can you draw out of a portfolio? And you really don't know, because we don't know the future, do we? So how much can I take out of my portfolio? If I'm using a natural income strategy and that income is appropriate, i.e. the manager's not pushing the income too hard, he's distributing an appropriate amount for the portfolio he has, you know that you are withdrawing that amount without eroding your capital, and your capital should tag along in line with income. Now, take a little step back. In accumulation, volatility is your friend. We all know about pound cost averaging. We all know, when the market's having a bit of a drawdown, you should be upping your savings rate and so on and so forth. And all of these things are true, pound cost averaging. In retirement, volatility is your enemy. Because if you're drawing too much out of a portfolio and you get a period of drawdown, you are selling a lot of units at the market lows, and you absolutely don't want to do. So it's a complete mirror of pound cost averaging. The real point about natural income is it nails down the safe withdrawal rate. If you've got an income that's growing in line with inflation, which is your needs in retirement, and you draw that level out of the portfolio, you are never eroding your capital. Now, of course, most clients can't do that. Most clients are going to be withdrawing out. But as an advisor, if you're looking at a fund which has consistently grown its income in line with inflation or above, and it's got a yield of X, that current yield is your safe withdrawal rate. If you're looking at a growth fund with no distribution, you don't know whether you're buying it the day before the tech bubble burst or at the bottom of the market in 2002. You don't know. And all of these, algorithmic services and clever forecasting services and all the other geniuses out there, whenever you ask them what the safe withdrawal rate is, they'll say 4 or maybe 4.5% or maybe 5, optimistic ones. But they'll say that, the day before the great crash. They'll say it, 3 days later, with the market 30% lower. The simple fact is you don't know future returns from a growth portfolio. But if that were an income portfolio, the day before the market crash, you'd be looking at a low yield. And at the bottom of the market, you'd be looking at a high yield. So it's telling you what the safe withdrawal rate is, an income strategy. If it's well run and properly put together, it gives you much more clarity and safety, because volatility is now your enemy. You need to know how much you can take out of that portfolio. And okay, you're going to be dipping into your capital, but at least you know how much you're dipping into it.
I was reading one of your articles, and you talk about being a fan of a bucketing approach. And can you kind of explain what this means and why you feel that's important?
We talked about why post-retirement planning is more complicated. Now, there's a golden rule when dealing with really complex tasks: break it down into its component parts. And post-retirement, you're looking at a number of different challenges, aren't you? You're looking at a basic level of income, immediate financial needs. Perhaps, when you move into retirement, you want to spend a lot of money in the early years. Then you go through the sort of healthy, but not traveling around. Maybe you're not so bothered about a new car, these kind of issues. And then you've got later life needs, and then you've got legacy. And all of these problems are actually distinct investment challenges. The time frames and the required returns and the risk that sits with it. You're probably less bothered. If you've got a huge pot and you can live on the income, how much is left at the end is sort of someone else's problem. So you can maybe take more risk with that if you've nailed down the income needs. But your basic expenditure, you don't want to be taking a lot of risk on that, and so on and so forth. So they're all different. Why would you sort of sit down and say, right, okay, I've got all these complex things. I think they add up to a risk profile 4. How do you know that? You don't know that. You don't know. But if you break it down and say, right, I can use this amount of the capital to cover the basic expenditure needs. I know I need to put this much to one side for big bills in the next 2 or 3 years. And the rest I can take a long-term view over and go with a growth strategy. Why not? Go with a higher risk growth strategy if you've got, and then that changes every year, of course. But at least you've broken the problem down into its component parts. You're not going to be 100% accurate on any of this, but you've broken it down into its component parts, and you've solved each appropriately on that journey. Otherwise, it feels a bit like a guess to me,
And I guess that does come back to, again, I keep going back to my introduction, but it does go back to that, is that, can you have the best of both worlds? So if you kind of feel that you're losing out a little bit on growth, and what you're saying is actually, if you break it down, if you've got some guaranteed income coming from one source, you need that topped up by some income through your pension, but actually you do have another pot that doesn't need that. You can put that into your growth. And I guess that's what you're sort of saying, isn't it?
I think it makes an awful lot of sense that, you want to, in the same way, a lot of advisors, they like to use annuities for vulnerable clients and so on and so forth.
Mm.
You can replace that with natural income for clients with slightly bigger pots, that you can nail down, this is how much your income you need for the very basic needs. And then you can say, well, I can afford to take a bit more risk over here. Maybe I know I'm going to be in cashing units to top up the income, but I know that pot's never going to run out, the long-term pot, because I've nailed down the natural income down here. And it just, to me, difficult task, hugely complicated. Break it down into component parts and find appropriate investment solutions for each component.
And it kind of leads on to my next question, which is sort of a more of a general one, and to some extent you've kind of covered it, but it'd be interesting to get more thoughts around this. There seems to be this huge focus on cost, on online guidance, and therefore many people seem to feel that they shouldn't pay for advice in retirement. Certainly listening to you today, do you think that people should seek advice, and why is that? Because I guess to some extent I could counter argue and say, well, I could work this out. I could build my pots. I could do it. And so, why do you think that people should seek advice? Is there a need, or could I just go for online guidance?
Personally, I think, and I say this to every one of my friends, even those who are fortunate enough to have enough money, the bit you're missing out on is the sheer complexity of the tax and regulatory and legal situation post-retirement. And frankly, whilst some people think they can do the investment piece themselves, have you really understand all of this other stuff about drawdown and so on and so forth, and the risk to that, and the fact that, some of your pots are going to be heritable, some aren't, some are going to be subject to IHT, some aren't, some are going to be subject to income tax, some aren't. This is hugely complex. And, if people think they can sit down and do it themselves, I would be very surprised if they wouldn't be getting huge value if they just employed an advisor to do it. Because I don't know how much you value your time, but, I've been in this industry an awful long time, and there are still things, you come up with that you think, mate, I never knew that. We should have known that a few years ago. I use an advisor myself, and everyone I meet, I always advise to use an advisor. Your needs are constantly changing. The regulatory environment's constantly changing. Somebody's full-time job to keep an eye on this, and then you've got, fund managers like myself whose full-time job is to keep an eye on that bit. You need to separate them and say this is, I think it's just hugely good value. Even if you've got a huge pot, you're not paying a huge amount for advice. And if you've got a huge pot, maybe you're not bothered. And if you lose it all, fine. But for those people in the realms of normal people, what they're paying for advice is just hugely good value in my view. It's just, why wouldn't you?
I think you've made a good point. I mean, I've got a financial planner as well, and there's a good reason for that. Is one, I've got someone to protect me from making a mistake, and that's a huge thing because I might feel I know everything, but ultimately, you can't know everything, and so I think it is so important. So yeah, thank you. I mean, today's been fascinating from my point of view. I'd love to know if you could offer some sort of words of wisdom to those who are preparing for income in retirement. And what would you say? Because again, going back to my introduction, I've got 5 to 10 years, and actually, I look at it and I think actually it's quite scary.
Yes.
Even though I
Tell
work
me.
in the industry, it's like it feels I've got to make the right decision. So, if you could offer words of wisdom, what would you say?
And it is scary, isn't it? Because pre-retirement, you're 30, 40, 50 years old. Whatever happens, you can earn some more money. Once you've retired, that's it. You're not going to earn any more money. And do you remember? I remember when I first started in the industry, they used to say, look, start your savings journey early. Didn't they? They used to say, start it early because time is your friend. You're going to build that pot. If you just prudently put a little bit away each year, build up very, very nicely. I think the same adage applies for retirement planning as that pot is built. You need to start the transition to, if you're going to use a natural income strategy, a natural income, a bucketing strategy, you need to take those decisions in the pre-retirement phase. You need to start moving your portfolio to the portfolio you're going to want post-retirement early. Because what you don't want to do is wake up one day and say, right, okay, advisor, I've retired now. I need X thousand pounds per annum. And him to go, oh, well, you've got completely the wrong portfolio. And this isn't a good time to be changing it. Because, let's pound cost averaging into our income strategies as well. Let's pound cost average into our defensive strategies for the immediate needs, because you don't know the level of the market the day you retire. If you average over the previous 5 years and the 5 years into early retirement, you're going to get a much better outcome unless you happen to be lucky and move into income strategies just when yields are at their highest. But we're not going to be, are we?
And I think that was just such a great way to end, because I think you're absolutely right, is that we'll always read about those people who have made an amazing investment decision at the
Yes.
end. And we all look at them and we all wish that we could be them. But the reality is that very few of us are. I mean, if we could all do that, you wouldn't have to worry about retirement. So,
But
um,
you can get a brilliant outcome just by being average if you're persistent and sensible about it.
yeah. And it comes down to, I remember listening to somebody and they said, how much are you prepared to lose of your wealth? And I thought that's a really good question.
Mm.
Because if you're prepared to lose 10% of your wealth, then effectively what you're saying is that 90% I want to be looked after. What you do with that other 10% is up to you. And
Yeah.
and I think we almost need to, our human behaviors almost need to shift to thinking, what are we prepared to lose?
Yeah.
And I love your word about income is the output, because I think retirement is the output as well, isn't it? It's how
Mm.
do you get to retirement, and or how do you go through retirement and deliver an output that fits your needs? And rather than trying to chase that golden growth that we all want, focus on the output. And that
Mm.
seems to me to be the most important thing.
That's
Um,
certainly what I do personally.
yeah,
Each year, I think, how much more income is my portfolio generating?
yeah,
Then I'm happy.
yeah. So I'd just like to say thank you to everyone who's listened to this podcast. And I want to thank you as well, David, for joining us, because, as I say, and I've said before, it's just been absolutely fascinating. I know on the Premier Miton website, there are some fantastic resources. I've read some of your articles as well. So I would recommend anyone listening to this today to take a look at those. So thank you very much, everyone, for listening today.